Nasdaq's price action over the last few weeks was absolutely beautiful. But what did the opening price of a session already reveal, and how could you have capitalized on them by simply applying the DR basics? In today's video, we'll walk through 3 textbook DR basic trades that unfolded over the past 2 weeks on Nasdaq, each one showing a different model, structure, and probability shifts. Step by step, candle by candle, this breakdown will help you understand how to read the market like a professional trader, stacking probabilities with logic, not emotion. Trade 1, October 9th, 2025. RDR opening price, early insights and opportunities. The regular DR session opens at 9:30 a.m. and the very first thing we do is look backward. What do the aftermarket and overnight sessions tell us? The overnight session respected the aftermarket highs and printed a lower low. That's a classic DR downside model structure. Additionally, the aftermarket box is larger than the overnight box, which already excludes a DR range expansion model. When the regular session opens, we're still respecting the downside structure. Overnight highs remain intact. So a DR downside model becomes the most favorable possible outcome for the session. Now, ideally, we want the first hour of the regular session to close as a red DR box, followed by a short confirmation. That's your textbook confirmation of probability alignment to the short side. And right at 10:30 a.m., that's exactly what happens. A red DR box followed by a short confirmation. Minutes later, the 1 standard deviation level is already reached before price even retraces back into the defining range. That's efficiency. But can we aim lower? If we project to 1.5 standard deviations, do we have supporting confluences? Absolutely. The previous day's regular session mid aligns to the tick with an open magnetic volume imbalance, something that eventually needs to be rebalanced. Stack that with the DR downside model and the red DR box and you have a strong case for continuation. When price retraces back into the defining range, it rejects a volume imbalance close to the range mid, a potential entry zone. Price revisits that same region multiple times, rejecting it again and again. At this point, the 1.5 standard deviation target hasn't been reached yet. With a stop above the range mid, this trade offers 6R to the target with multiple DR basics stacked perfectly in your favor. And we didn't even include previous DR levels or the tick grid indicator for this trade. Just the DR basics alone created a clean, high probability short. That's all you need to start seeing the market differently. Trade 2, September 30th, 2025, opening price insights and managing risk with 2 bullets. Once again, the regular session opens at 9:30 a.m. The RDR opening candle already gives you a key information. You can immediately exclude both the upside and downside models. Why? Because it opened above the overnight session highs, making a downside model not possible anymore, and the upside model wasn't even intact at all. Next thing, the aftermarket DR box is smaller than the overnight DR box. That means a range expansion model is possible. We don't know yet since the box hasn't fully formed. That's a huge piece of information already. Fast forward to 10 a.m., 30 minutes before the DR range closes. What information can you get out of the current situation? Measuring from the lowest to highest 5-minute close, you already see that this current IDR box is larger than the previous one. The range expansion model is now confirmed before the box has fully formed. While the range continues forming, you can prepare already. Mark important volume imbalances and previous DR levels aligning with the range. By 10:30 a.m., the session is formed. Now you wait for confirmation. At 10:55 a.m., price confirms long. That's your probability shift to the upside. The natural target in a DR range expansion model is 1 standard deviation. Minutes later, price retraces into the range mid, rejecting both the mid and a previous DR session level, also aligning with the current ODR lows. That's your entry. The setup is perfect, but this one gets stopped out, and that's okay. Risk management always comes first. Then the market does what it often does. It offers you a retirement setup. A few minutes later, you see clean rejections at the previous DR levels and IDR low, textbook confirmation. That's the setup where probabilities reset and the market rewards patience. The second trade offers 5R potential, reaching the 1 SD target beautifully. The earlier one R loss is recovered and the session closes with a net +4 R profit. Remember, if your system gives you a second high probability setup within the same structure, take it. That's the edge. Trade 3, September 29, 2025, recognizing strong upside potential and probability shifts. Let's move to a day earlier. The aftermarket session starts with a green DR box, followed by a long confirmation, then retraces to its mid, rejecting it twice before offering a strong trade to the upside. The overnight session continues this narrative, opens higher, closes green, and confirms long immediately. That's strength and structure. How can you see the strength clearly? The overnight session never touches the aftermarket highs. There's a visible gap between them. That gap keeps the DR upside model intact and excludes a range expansion model because the overnight box is smaller than the aftermarket. Price expands higher toward the 1 SD level without even retracing back into the range. It tests a retracement into the defining range twice, then finally retraces, showing rejections right at the IDR high. 30 minutes later, price pulls back again and rejects the closing price. And remember, in a green DR box, that level can be very sensitive, especially if it's backed by upside probabilities like in this case. It's a critical reference point. A few minutes after that, a close back above the range, strength confirmed again. That's your trade opportunity. Stop below the closing price, target the next SD level, 3R potential, and the target reached perfectly to the tick just a few minutes after the session ends. That's textbook DR upside behavior. No indicators, no confusion, just logic, levels, and probabilities. Later that day, when the regular session started, the upside model continued and overextended. The regular DR session failed to confirm longs, wicket below its low, violated the overnight session mid, which immediately decreased the upside probability. After that event, a short confirmation followed and price continued into the short direction, violating all overnight session levels. Across these 3 days, you've just seen how the DR basics alone can give you incredible clarity, whether it's a downside model, range expansion, or upside model. All it takes is reading the board one move ahead, like chess. Recognize structure, identify your models, stack your confluences, and let probabilities do their job. But even if you only apply what you've learned here today, you'll already trade with more clarity than 95% of retail traders out there. Trade smart, stay disciplined, and keep learning. See you in the next video. We're gonna take on the world.